Hello everyone. So under this video, let us solve this problem. It says Mr. X is the owner of a house which consists of three independent units. So the ground floor, which is equal to 40%, is self-occupied, and the first floor is also equal to 40%, which is let out. The second floor, which is equal to 20%, is also let out. Then the other information which has been given with regards to this house is the fair rental value, the municipal valuation, the standard rent, the municipal taxes, which is 10% of the MRV, then the repairs expenses, the ground rent, then the actual rent received, that is for the ground floor, 5,000 per month. For the second floor, it's 2,000 per month. Then the first floor unit remained vacant for 2 months. Then Mr. X started the construction of the house in 2016, in which he borrowed rupees 5 lakhs on 1/7/2016 at the rate of 14% for the completion of the house, and the house was finally completed on 15 July 2018. Then Mr. X returned loan of rupees 1 lakh on 31st March 2019. Then we have to find out the income from house property for the assessment year 2020-21 of Mr. X. So since Mr. X has taken a loan for the completion of the house, so first of all we have to find out the pre-construction interest and also the current year interest. So let us look at the calculation of pre-construction interest. So there are two things which we have to note it down, that is the date of borrowing and the date of completion. So the date of borrowing is 1st July 2016 and the date of completion is 15 July 2018. So the pre-construction period will be from 1st July 2016 to 31st March 2018, which is the financial year immediately preceding to the year of completion, that is on 15 July 2018. So the pre-construction period in total will be 21 months. The total interest from 1st July 2016 to 31st March 2018 will be rupees 5 lakhs, that is the amount of loan which has been taken. Then the rate of interest 14%, then into 21 months, then divided by 12 to get it per annum. So in which we have 1,22,500. So this total pre-construction interest will be allowed as deduction in 5 equal installment for 5 previous year. So for this current previous year will be 24,500. So the current previous year interest will be the outstanding amount of loan as on 1st April 2019, which is 5 lakhs minus 1 lakh, and the outstanding amount will be rupees 4 lakhs since he has repaid rupees 1 lakh on 31st March 2019. So the current previous year interest will be the outstanding amount of loan as on 1st April 2019. So as on 1st April 2019, the outstanding amount of loan will be rupees 4 lakh since he has paid rupees 1 lakh on 31st March 2019. So the interest for the current previous year will be 4 lakhs into 14%, which will come to rupees 56,000. So the total interest of the previous year 2019-20 will be the pre-construction interest plus the current previous year interest. So the total will be 80,500, and since the house has 3 units, this total interest of 80,500 will be divided in the ratio of 40:40:20% or 2:2:1. So the interest on loan for the first unit will be 80,500 into 2 divided by 5, which will get 32,200, and for the second unit will be also 32,200. And for the third unit will be 80,500 into 1 divided by 5, which is 16,100. So now let us look at the solution. So we know that the house has been divided into 3 units. So unit 1 is the ground floor, which is 40%. Then unit 2 is the first floor, which is let out, that is 40%. And unit 3, which is also being let out, which is equal to 20%. So under step 1, we have to find out the reasonable expected rent. So to find out the reasonable expected rent, we have to take the municipal valuation of fair rent, whichever is higher, but subject to the maximum of SR. So if you look at the problem, the fair rental value is 90,000, the municipal valuation is rupees 1 lakh, but the standard rent is rupees 80,000. So first of all, you have to compare between the municipal valuation and the fair rental value, whichever is higher. So in this case, the municipal valuation is higher, that is rupees 1 lakh. But it is subject to the maximum of the standard rent. So the standard rent is 80,000. So we have to take 80,000 as the reasonable expected rent. So since we know that the house has been divided in 3 units, that is in the ratio of 40% is to 40% is 20%. So this reasonable expected rent will be divided into 3 units in the ratio of 2:2:1. So for the first unit it will be 32,000, for the second unit it will be 32,000, and for the last unit, that is unit 3, will be 16,000. Then under step 2, you have to find out the rent received or receivable after deducting the unrealized rent but before adjusting loss due to vacancy. So in this case, we don't have any unrealized rent. So we'll have to find out the rent received or receivable. So for the first house, it is self-occupied. So the rent received will be nil. Then for the second unit, the rent per month is 5,000. So per annum will come to 60,000. And for the third unit, the rent per month is 2,000. Then per annum will come to 24,000. Then step 3, you have to compare between step 1 or step 2, whichever is higher. So in the case of the second unit, it will be 60,000. Then in the case of the third unit, it will be 24,000. So remember, you have to keep this in mind for the self-occupied house, the net annual value is nil. So we need not do anything under step 3 and step 4 and step 5. So now let's move on to step 4. So the loss due to vacancy. So only need to remain vacant for 2 months. So the rent per month is 5,000. For 2 months, we'll have here 10,000. Then after that, we have to, under step 5, we'll find out the gross annual value, which is step 3 minus step 4. So for unit 2, the gross annual value will be 50,000. And for unit 3, the gross annual value will be 24,000. Then from the gross annual value, you have to less the municipal tax to get a net annual value. So the municipal tax in this case, it's 10% of the MRV. So 10% of the MRV, which is 1 lakh, this will give you 10,000, and this 10,000 again has to be divided among the 3 units. That is in the ratio of 2:2:1. So for the first unit, we need not do anything because under the Income Tax Act, the net annual value of a self-occupied house is nil. So for the second unit, we have to divide this rupees 10,000, which is the municipal tax, in the ratio of 2:1. So for the second unit, then the municipal tax will be 4,000, and for the third unit, the municipal tax will be 2,000. Then after deducting the municipal tax, we'll get the net annual value. Then for the first unit, it will be nil. Then for the second unit, it will be 46,000, and for the third unit, it will be 22,000. Then from the net annual value, we have to minus the deduction under section 24. So under section 24, we have the first one, that is a standard deduction under section 24A, which is 30% of the net annual value. So we have to keep this in mind. For any self-occupied house, there is no standard deduction under section 24A, since the net annual value is nil. So for the second unit, the standard deduction will be 30% of 46,000, that will be 13,800. Then for the unit 3, it will be 30% of 22,000, which will be 6,600. Then we also have the interest on loan taken under section 24B. So if you look from the note, the interest on loan has been divided in the ratio of 2:2:1, which for the first unit will be 32,200. For the second unit, it will be 32,200, and for unit 3, it will be 16,100. So if you deduct the net annual value, if you minus the deduction under section 24 from the net annual value, you'll get the income or the loss from house property. So for unit 1, it is a loss of 32,200. For unit 2, it's nil, and for unit 3, it is minus 700. So that is a loss of 700. So the loss under the head house property will be minus 32,200 for the first unit, then also minus 700 for the third unit. So the loss under the head house property will be minus 32,900. So it has to be noted down that the net, so I'll repeat, you have to note it down that the net annual value of a self-occupied house is nil under section 23(2)(a).